You have probably heard this advice before: just buy an index fund and wait. And if you are new to investing, that can sound way too simple to be true. Index funds feel too simple to work because we are trained to trust complexity. We assume harder means smarter, and simple means missing something important. But beginner investing does not need to be exciting. It needs to be low cost, repeatable, and consistent. Welcome to Plain Money. I am Finn. In the next few minutes, you will learn what an index fund is, why so many beginners start with one, and how to invest without overthinking every decision. An index fund is basically a basket. Instead of betting everything on one stock, you buy a fund that holds hundreds or even thousands of companies at once. That means you are owning a slice of the market, not trying to guess one winner. Here is why that feels wrong emotionally. Complexity sounds safer. A friend brags about a hot stock, an influencer promises a secret strategy, and boring index funds sound too quiet to be powerful. But quiet is not broken. Quiet is the strategy. The point is not to impress people. The point is to stay invested for years. A simple low-cost index fund often beats confusion, stress, and constant switching. Before you invest, cover the foundation first. Build a starter emergency fund, pay down high-interest debt, and make sure you can handle basic bills without needing to sell investments in a panic. Then invest in this order. First, get your full employer 401k match if you have one. That is one of the easiest wins in personal finance, because the match is part of your compensation. Next, consider a Roth IRA if you qualify. After that, increase your 401k contributions over time as your income grows and your budget becomes more stable. If you are 30 and nervous about your 401k, you are completely normal. The beginner answer is not to build a perfect portfolio on day one. Start with one simple fund, automate it, and improve later. Fees matter more than most beginners realize. A 1% fee sounds tiny, but over decades it can quietly eat a huge part of your gains. That is why low-cost index funds matter. Boring and cheap is a feature, not a weakness. Starting beats optimizing on day one. What should you avoid? Day trading, panic selling during drops, chasing random stock tips, and constantly switching funds because of short-term headlines. Simple and steady usually wins. The hard part is behavior, not picking the perfect ticker. Set it up once, automate your contributions, and try not to check the market every single day. Your starter plan is simple: log into your 401k, contribute enough to get the full employer match, pick one broad low-cost fund, and set an automatic increase for later when you can afford more. If this helped, subscribe to Plain Money for beginner finance explainers every week. No hype, no panic, no complicated jargon, just simple steps for building long-term wealth.